Welcome everyone to another episode of Wolfe Street. We're back, baby. Sort of. For those of you that don't know, and for those of you that might have forgotten, my name is Wolfe, and thank you for checking me out. This has been a while since I've done one of these. I think it's important, though, ahead of our quote-unquote most important rate decision ever to kind of provide some sort of thought and clarity around what it is that I'm thinking. So I just wanted to, on the front end, say thank you. Thank you for your support. Thank you for reaching out. Some of you who have reached out. Thank you for, staying in contact. For some of you that have stayed in contact. It's been a while. I thought it was important to put some clarity around this Fed decision that's coming up. So I thought it'd be a good time to kind of break the silence and put a voice to some of the content, some of the words that I've been putting out. And for those of you that haven't seen it or haven't kept up with any of the shorts or anything like that, please check it out. It's on my YouTube. I'm posting content in Discord, etc. And if you have, I appreciate it. And I just want to say thank you on the front end before I just jump right into it. So let's just jump right into it. But before that, as always, this content and the content in this video or any videos of mine is for educational, informational, and emphasis on entertainment purposes only. It is opinion based. So these are my opinions. They may or may not change they will change given how things change. They are not to be constituted as financial advice. I'm not a financial advisor. Don't take my opinions as advice. They're not advice. They're just my opinions. And as we've seen in this market or any market in general, but especially this one, opinions tend to change pretty rapidly, as do, sentiments. So I'm not here telling you that this is financial advice. In fact, I'm just telling you it's the opposite. And if you need financial advice, please talk to someone. I'm begging you, please talk to someone who can help you achieve whatever goals you are trying to set for yourselves moving forward. Once again, please talk to a financial advisor. Get your stuff straight. Don't listen to a random voice, random emoji, random dude on the internet. Talk to someone, build a plan out, and do what is in your best interest for yourself. So that's enough of that diatribe. I'm going to just jump right into it. We have the most important, quote unquote, Fed decision of our lifetime. That seems to be the case every time, but this time more so than most. And going into it, we have three main problems, right? We have four now, but at the time that when I made this, we have three main problems. And the problems are, for the Fed, inflation, yields, and a recession that is looming, right? Now, the fourth one is this banking crisis. That's sort of a crisis, but not really a crisis because it's not the major banks, but it could be a crisis because commercial real estate might be affected and other real estate might be affected, and maybe deposits are backed, but are they not backed? Like, that might be a crisis in and of itself. So there might be four, but let's just stick to these three because these are the three main things that kind of shape the narrative around the Fed moving forward. And on the back of these three problems, inflation, which is part of the Fed's dual mandate, where they need to get inflation back down to 2%. Last I checked, it was a lot higher than that. Yields, right? So we had an inversion of yield curves, and that usually signals a recession. That it basically kind of dries up the system of liquidity. And then the looming recession is the other part of the dual mandate, because on the back of a recession, people lose their jobs. And when people lose their jobs, the Fed's not doing a very good job to stimulate and keep the economy healthy, right? And so those are the three main problems that are to be kept in the back of our mind ahead of this Fed decision. So when we talk about this, right, everybody has been talking about what sort of landing are we going to get on the back of what the Fed's done and on the back of what the Fed's actions and policies will be, right? So we have three potential situations for landings, right? And I've worked this out. I'm going to do another video here shortly after the Fed, and I'll go into this a little more depth for this. But essentially, there's three probabilities. You got a hard landing, you have a recession, and a soft landing or something else, right? So the hard landing, which is, I personally don't know how they're not going to get a hard landing, given how stressed some of these things have gotten. But some of you might ask, well, what's the difference between a recession and a hard landing, right? So a recession, you can have a recession without having a hard landing, right? You can have a recession where people lose their jobs and the economy slows down and goes negative, but it's not like this cataclysmic thing that just becomes a crisis, right? A hard landing is more of like if you just think of these situations as landing a plane. You have a soft landing, which is just like a perfect landing by the pilot. You have a hard landing, which is like, oh crap, there's an emergency and we had to land in a lake or something. And then you have, a recession, which is, it could be, it could be a problematic landing where you landed somewhere that you didn't mean to land, but there's no damage and there's no casualties or anything like that. And then there's another category here that I have where it says other, and in this case, the other is primarily something that we are not foreseeing. So maybe it could be exogenous risk. It could be a war. It could be something else, right? So I've kind of grouped those things together, but I wanted to kind of emphasize that on the front end. Okay, so how did we get here, right? So if we go back to several videos in before, and if you go to 2022, middle of 2022, back in June, the talking point was that the Fed was raising rates aggressively into an over-leveraged system in a historical way, with slackening demand and growing inventories, right? So that was if you just go back to a lot of the videos that were in the past, those were kind of like the talking points. And so on the back of that, we took a cautious approach to equities in general, to risk assets in general, because it was just an unprecedented situation. Here we are now in 2023, and you've seen some of these banking situations kind of play out on the back of this hope that this downtrend in, long-term Fed funds rates would continue to present lower highs and lower lows. And I'm not saying that people looked at a chart and made a decision, but essentially it was built into the consciousness of people that the Fed can't go any higher because when they do go higher, it'll really cause some stress. So maybe I don't knee jerk into taking some precautions because they can't, right? And that's kind of been the fool's thought process, in the last year or so. Let me go back real quick. So the first thing to remember on the back of this is the pandemic. On the back of the pandemic, we got a surge of liquidity that created a demand for goods because we were all locked up in our houses, and we were buying all of our iPads, all of our laptops, all of our MacBooks, all of our ATVs, whatever, houses, whatever, right? Because we had a surge of liquidity, and on the back of that, we had no more demand for goods, and we were moving into like a services-based thing, while we had unprecedented hiking by the Federal Reserve, right? So those are like the high arcing thoughts ahead of what's been going on now. These are things that we talked about last year, right? And so systemic risk on the back of this in a banking sector is a concern, but that's not really what kind of got us here. That was just a function of what was transpiring by the Federal Reserve, essentially, and by just to be quite honest, poor risk management, right? So, but those are the main things to kind of keep in the back of our minds on the back of this. All right, so the next slide, right? So we talked about the yield curve on the front end, and generally everybody's got a yield curve that they prefer. Everybody has, whether it's 2s, 10s, whatever, everybody's got a yield curve that they prefer. But so it's not a set in stone thing to be like, oh, well, the 2s, 10s inverted, and so therefore we're going to go into recession. However, historically, anytime you've had more than half, and I'm saying more than half here generally, but anytime you've had 55% or more of your yield curves invert, that has generally meant that we tipped into a recession. And so when we are in this situation where we have essentially 90+% of yield curves inverted, that is red line over the top inversions. And so when we see this sort of stuff and it gets that bad, you just go back and look at the times that it's done that. The year 2000, we all know what happened then, late 80s, and then here's your Volcker era, right? And so there's never been an instance where we've gotten this inverted on yield curves across the board and it didn't result in a recession. So that's kind of why, if you've been present or if you've been around Discord or whatever, and you've heard me say basically, I'm not willing to put my neck out there. This is why, because I saw it firsthand in '07 to '09, and it was not nearly as bad as this, right? So that is one I want to say emphasis on one situation to keep in the back of our minds. So let's keep it going. So the other thing, right? So you have real liquidity, which is M2 money supply, equities, and bond mutual funds and ETFs, and then you minus industrial production growth rates, and that'll give you real liquidity. And if you take a look at what happened when we started to stimulate during COVID, you had you had this real liquidity spike to historic levels. Well, now we're doing the inverse, right? So we're unwinding, right? Real liquidity is sharply lower, and it's sharply reversing on the back of this sharp spike. And a lot of that has to do with the Fed trying to mitigate inflation, and then some of it's just the unwind that had to happen because of how much excess there was in the system. And so let's just keep that going. Same kind of thought process. Just like we had a historical money supply ramp, we're seeing a historical unwind in money supply. And this shows it to you a little bit clearer. So these two things go hand in hand, right? So here's your real liquidity, M2 plus whatever. And here's your money supply, M2 year over year. So one is a function of the other. When you unwind money supply like this, you are going to get a real liquidity that is significantly negative, right? And so if you just go back here, we've never been this negative from a real liquidity standpoint and a money supply standpoint. So this is the fastest Fed tightening cycle in history, and it caused M2 to stay in negative territory. Not just get there, but we've been stuck here now for the first time ever. So these are like exogenous things, and these are things that are unprecedented, and it's not something that I'm willing to stick my neck out for and just kind of like hope for the best, especially when we have a hawkish Fed, right? So let's just keep it going. So when we see all this stuff and you see the market going up as much as it's been going up in the last week, month, day to day, whatever, you start to think, well, maybe the worst is behind us. Well, that's hard to say too, and the main reason for that is we haven't had earnings revisions, and we haven't had revisions for this year and next year come down, right? So we've had this like steady climb in earnings expectations, and they're still optimistic. I haven't heard very many revisions, and I haven't seen very many firms come out and revise things. In fact, some of these reports that are coming out better in some instances, though the ones that are revising significantly worse. But the ones that aren't, some of them are still coming in better than expected, quote unquote, which kind of creates more of this chaos and more of this uncertainty around things, right? So the next thing that we have to think about is the odds of everything that we just saw are clearly suggesting we're going to go into a recession, or it could be worse, right? And so when we have those things alone on the front end ahead of the Fed, and we have inflation still raging or simmering or boiling or whatever word you want to use here, the next thing, it gets worse. So enter a banking chaos on the back of the deposit fiasco for Silicon Valley Bank and FRC potentially and Credit Suisse, etc. So the thing that I can point to with this is that there is almost never just one cockroach, right? And so we've seen a couple now. Generally, that's not the end of things. Generally, that's the beginning of things for the banking sector in particular, and it's not a good idea to kind of get ahead of whether or not these things play out, right? And so this is going to be a very brief slide, But I'm only and I'll go over it on the next video. But the reason I'm pulling it up here is to kind of just show a historical precedent for this. So the BKX hasn't been around too long, but since it's been around, it's been around since 1995. Since it's been around, the 3-day rate of change has only hit the level it hit last week in 1998, 2002, 2008, 2011, and 2020. Right, and so these are just the very brief observations for this. Right, and that's level of decline typically leads to a bit more weakness, followed by an oversold rally in the middle of a market decline rather than the end. So what did we just get? We had an oversold rally in some of these banks and the market in particular. The second point, the median short-term gain from the signal is about 8.8%, indicating a rebound in the next few weeks, right? So this was last week. I'm not sure where we're at on this 8.8%, but generally it just gives you a barometer of like what it is to expect. And then in every case, the S&P either fell to or broke the initial signal price. So in every case, when you have this bottom on the BKX or in the market on the back of the BKX, you went back to or broke through that starting point. So when we see these things kind of bounce, it's important to kind of keep this anecdotal historical data in the back of your mind. Obviously, things can be different from, you could have an instance where things are different, but it's important to keep it in the back of your mind. Okay, so let's just jump to, the bread and butter, wrap this up with Jerome Powell, figure out what it is that we should consider on the back of things, right? And one interesting thing on the back of this BKX and on the back of the banks in the last couple of weeks is going into the first sign of the Silicon Valley troubles. We had a rate hike expectation for this meeting coming up that was 50 basis points. So if you go back to the beginning of March when Powell spoke on Capitol Hill and in Congress, in particular in front of the Senate and Congress, there was a completely different tone in the market and anybody that kind of like expected what the Fed would do. The one thing that we kind of talked about back then that you may or may not remember is that the Fed's meeting this month would come at the end of the month, which is generally like a little bit different. It usually kind of falls in the middle of the month, but this time around it comes at the end of the month, which kind of and it comes on the back of important data points. I think CPI was one. I can't remember the other one. PCE, I think, was the other one, and a jobs number. And it comes after those. So we understood that at the end of the month, we're going to have the data that we wanted, and we'll get an understanding of what it was that the Fed would point to and look at, yada, yada, yada. If you talk to anybody about what it is the Fed's going to do tomorrow, it's very rare that people point to those things. And it's very rare that people point to Powell. It's very rare they point to inflation. It's very rare they point to, what the Fed looks at, whether it's PCE inflation, whether it's services inflation, whether it's the jobs report, etc. The focus is completely flipped to banks, and it's flipped to they've pushed it too far. There's stress in the system, and they have to act and they have to unwind. So let's just go back real quick and kind of go over what it was that he said when he spoke, in Washington, D.C. The first thing he said, my colleagues and I are acutely aware that high inflation is causing significant hardship, and we are strongly committed to returning inflation to our 2% goal. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we are confident the job is done. So if you go back to, before any of this Silicon Valley Bank stuff, and before Credit Suisse and before, FRC, etc., the tone was completely different, right? And so now the belief is that because of this stress that is occurring in a regional banking sector that may or may not extend to, larger banks, and may or may not extend to some sort of contagion event, that the Fed will have to soften on these stances. So I'm going to go back 2 slides just to say my colleagues and I are acutely aware of the high inflation is aware that high inflation is causing significant hardship, and we are strongly committed to returning inflation to our 2% goal. That's a completely different narrative and completely different tone. So the main thing that I want to kind of focus on for tomorrow, and what I want to pay attention to, is which Powell are we going to get? Which Federal Reserve are we going to get? Are we going to get the Federal Reserve that still sticks to their gun and says, hey, in fact, now that the banking system has done part of our job for us, if we keep this hawkish stance, we can kind of beat down the excess? Are we going to get that Fed, or are we going to get the Fed that just kind of capitulates like they did in the end of 2018 into 2019, which ultimately caused us the ruckus that put us in this mess? If you remember, at the end of 2018, the Fed was beginning to tighten. Trump basically batted down at Powell on Twitter and in public, and the Fed walked back their tightening very quickly in 2019. And then a year later, we had COVID, and they had to stimulate the economy from a lower base. So that's the point that I want to pay attention to. Are we going to get the Fed that talks like this, like the historical record cautions against strongly against prematurely loosening policy? We will stay the course until the job is done. I remember, in the last 2-3 times this guy spoke, I remember the number of times that he said, we will stay the course until the job is done. That was like his catchphrase. I borderline want to put it on a t-shirt because it's insane, right? Like, that was the point. And then the other point behind that is it was to be data dependent while looking at data that was not only old, right? You're not just looking at, like, so take a look at whether it's PCE, jobs, whatever. You're taking a look at older data, but that data a lot of times gets revised a few months later, right? So you're making current policy decisions on old data that changes, which that was, if we go back to March, the beginning of March, that was the conversation, right? That's what we were talking about. Now we're talking about something completely different. So going into tomorrow, we have there's three things, right? So you've got a dovish stance, you have a hawkish stance, you have a panic stance. Dovish stance, which is what everybody, this is what people believe to be dovish in general. The Fed comes out and says something along the lines of, we got to be mindful of data. We're going to have 25 basis points or no hike, right? And we're going to give a softer tone, and given light of things that have happened recently, we have to take a more cautious approach with rates, right? So that's the dovish stance. Are they going to come out and do that, or are they going to continue with their hawkish stance, right? So the market is priced in at an 86%, last I checked, chance for 25 basis points tomorrow. Historically, anytime that number's been above 70%, they don't go against status quo. If they were to go against status quo, that would really F some shit up, right? And so that is something to pay attention to. If they continue with this hawkish tone on the back of what we just saw in banking, a lot of this hopium is going to get really squeezed the other way. Remember, if you follow Chem Croissant on Twitter, there was a point where he kept saying the Fed's going to sell calls. And this was a couple before the banking stuff. The Fed's going to sell calls, and it wasn't literally, even though it came off literally. The Fed's going to sell calls. Well, are they going to go back to that, right? Are they going to reclaim the narrative from people who were talking about stress in the system and the Silicon Valley Bank stuff and the FRC stuff, or are they going to just simply, kind of let the stress do their job for them? Now, the third one, and this is the one that kind of gets viewed as, if you follow the commander Commander-Chief in tweet, whatever he calls himself, Elon, he mentioned the other day that the Fed should cut 50 basis points. And a lot of people kind of run with that and they say, there's a lot of stress. They have to do it, right? Well, if they did that, I believe, like if they came out tomorrow and said we're going to cut 50 basis points, I believe on the back of that you might see like a sugar high run, but I believe that it would be met with, kind of like panic selling. Because if they come out and they were to do something that aggressively, it's my opinion that it would spook people enough. Emphasis on opinion here. Spook people enough to where they go, what do they know that we don't, kind of thing, right? And the logic here is, if the Fed is going to do that, they basically are doing that because there's some sort of stress in the banking system that people aren't positioned or planned out for. The second thing is if they stick to their guns and they are, not just going to hike 25 basis points, but the path. If you look at the Fed funds futures, they have rates starting to completely go downhill. You know, on, from midsummer, I believe, all the way until 2024. If that starts getting pushed out, or if it stays higher for longer as well, I think things there would be mispriced as well. And then so let's just move along, just cover scenarios more clearly. 25 basis points. This is what the market's pricing in. And again, this, in my opinion, though, the 25 basis point, I just want to say this: 25 basis point is a worst case scenario for me, right? And if we're gonna do 25, or we're gonna pause, and that's the worst case scenario for me. And the reason that's the worst case scenario for me is because I believe that we have to flush. We have to flush this. We get down like 5% or 6%, and then there's a bid, and it's positioning. Some people are offsides for the long side, some people are offsides to the short side, and it's just this back and forth, back and forth, back and forth. I believe that you have to have the straw that breaks the camel's back in order for things to actually flush out, and in order for things to actually start to base, and for us to start to price, the next phase of whatever it is that's going to happen. I don't think that they should remain aggressive moving forward, like, the next several quarters or anything like that. But I do, like at the beginning of this, I was saying, if you go back and listen, I was saying that it was my opinion that if you are at a base of like 0 to 1, and you have to battle inflation, you have to battle this stuff, it is better to do it in the short term aggressively than to draw it out, because the longer you draw it out on the back of the money supply that was printed, or that was injected into the system, the more you get people to acclimate to it. And we're seeing that still, right? Like today we got data on housing. This was the first month, and I think like 10 that you had buyers step in the way that they stepped in. And it's essentially just people waiting to deploy their capital, right? And so that's one way to look at it. Now, the scenario number two is 50 basis points, right? And so the market's pricing in an 85% chance of 25 basis point move. Again, we just talked about this. When it gets above 70%, the Fed doesn't usually they never go against anything that's above 70%. So hike of 50 basis points gonna spook people, unless they come out and say, "Hey, this is our 50 and we're done." We're gonna the next couple of meetings that we're gonna see, we're just gonna see if we can start to unwind, right? But the fear here is, and like any hint of when are we gonna unwind, is people are just looking for any excuse to come out and try to buy some sort of risk asset, right? And so a 50 basis point hike and language around data dependence and stay the course would really catch people off guard, in my opinion, right? Because if you're pricing in 25 and they're coming out and they're going to hit you with 50 and tell you that they're going to stay the course, that's out of bounds for what people are expecting. Anything else, right? So that's scenario number 3. The caution here is around anything unexpected, right? Again, we talked about it in the last slide. Any rhetoric that hints that the recent banking events are not one-off, or there's some sort of systemic shock, they would cause some panic, right? And then conversely, like if they come out cut and they tell you we have to cut because there's some shock waves that are coming, that's going to cause some panic, right? And so again, I'm in the camp that an unexpected cut would spook people, and it would come on the back of things being far worse from a banking sector's perspective or an economic perspective than anyone's pricing it. So, I come back from a multi-month hiatus. I'm making a video, and I got nothing but bad, like terrible, not positive things to say, right? And I'm sorry for that. But there is a silver lining, and there is a positive, right? So it's my opinion that everything that I just said, all this negativity, and they need to flush out the excess, and the Fed, they can't be wishy-washy, and the sooner that we unwind, the better it is. It's my opinion. This is a positive, right? So this is how positivity is made whole. People say, and the saying is, it's always darkest before the dawn, right? So it's my opinion that we are going to go into a recession. Not sure why this is not loading. That's not fun. We are going into a recession. It's my opinion that we are gonna go into a recession, and that's weird. I'm not sure why it's not the slide's not loading the way it should, but I'm not sure why. But it's my opinion that we are going to go into a recession, and the recession is actually a bull case, right? And so the point here is that a recession is seen as a positive outlook for the market because it leads to a sharp drop in short-term interest rates. Remember, our goal for where we're going to try to find the bottom is we're going to see 2-year yields peak and then market test or make new lows. And that will give us some sort of signal that the all clear is around the corner from a historical perspective. And so if we get to a point where you get a sharp drop in short-term interest rates, which is, we started seeing this recently, and then we start to get like actual bad news is bad news, and we get recessionary stuff. I'm gonna move to the other slide because it's bugging me. And you start to get bad news is bad news because actual recession stuff. Then it sets up a situation for bad news to be bad news, and for us to potentially price out a bottom. And so a bull case is through a recession, in my opinion. It's just a matter of how bad that recession can be. If it the longer that we kind of pussyfoot around it, the more difficult it will be, and the sharper it will be, and the longer it will be. So it's my opinion that the Fed is still raising rates currently. The banking crisis is not the end. We're just like in the middle innings of it. Maybe the later mid, but middle innings of it. And bank lending standards are still tightening. And so when we have these things kind of combine, we are not at the bottom. And we have to go through the bottom, in my opinion, in order for us to see the end of this bear market that's been going on since, depending on what time frame you want to use, but since, let's call it the beginning of last year. So it's been a while. I want to say thanks again for checking me out. Feel free to reach out on social media, except Twitter. I'm not on Twitter. Feel free to drop me a line on contact page on my website. It's everytimeicash.com/contact. Instagram at everytimeicash. YouTube everytimeicash. TikTok, I don't really use that one that much, but it's up there at everytimeicash. And as always, please stay safe, stay profitable, and stay locked